Hi, I'm Pam Kruger.
And I'm Jack Gallagher from Money Track.
Money Track is a fresh, new public television series that gives consumers the tools they need to become wise and safe investors. John Bogle is one of the best-known investors in the world, and he's back with us now. John, your idea was to create a brand new type of mutual fund where once you buy it, you're pretty much done?
My rule for investors is buy the entire U.S. stock market, hold it forever, and above all, don't peak. Never look. And you'd be amazed you will be amazed at how much money you have at the end of the period.
See, I think it's my emotions that get in the way, these dreams of making tons of money in the stock market, or my deepest fears about losing it all in the stock market. Now, along comes the index fund, which sort of takes the emotion out of investing.
Think about this for a minute. When the stock market is at its peak, the very day it reaches that peak, optimism is at its all-time peak as well. That's why the stock market is high. We're all optimistic about future prospects. So stocks are very highly priced, and that's when you want to buy. On the other hand, what happens when the stock market hits a low? Pessimism is rife. People are scared to death, and that's when the temptation is to sell. So consider the picture. You're buying. Your emotions tell you to buy at the top. Your emotions tell you to sell at the bottom. That is not a good idea. Eventually, you won't have any money left. So what do you do about that? I think what you do is try and have a little balance in your portfolio of bonds, of all things. So when the stock market goes down, you'll have a little anchor of stability, an anchor to windward in the form of a stable bond account, which will produce some income for you.
Now, John, what about costs? We haven't mentioned that fact yet. You have to subtract all the commissions and the fees that those middlemen make, whether it's a broker or whether it's a mutual fund. Now, index funds seem to cost next to nothing to buy. How is that?
Because the index fund takes the cost out of investing in the market. You don't need any money managers. You don't need any security analysts. So the index fund can run at somewhere less than 0.2% a year, and maybe less than even 0.1%. So you can really capture the market's return, and it turns out that's a huge accomplishment.
The Money Track series is not sponsored by the financial services industry.
Nope. We are funded entirely by a grant from the nonprofit Investor Protection Trust. To find out when and where you can watch Money Track, go to moneytrack.org.
And remember, always investigate before you invest.